Stocks ticking higher ahead of tomorrow's crucial consumer inflation report. Now we're going to get the CPI print ahead of the bell tomorrow, but this morning's moves, and what we're seeing at the open, is in reaction to that PPI print that we got out this morning, softer than expected. Because of that, you're looking at traders pricing in higher odds that we actually could see a 50 basis point hike in September. Many are remaining confident that we are going to get some sort of cut next month. Now, here to discuss that and more, we want to bring in Dennis Gartman. He's a former editor and publisher of the Gartman Letter, also University of Akron's Endowment Committee's chairman. Dennis, it's great to have you here. So first, let's start on inflation and kind of the improvement that we have been seeing there. I'm curious from your perspective what you make of this back and forth that we have been seeing about the timing of when the Fed is going to cut, the degree in which the cuts are likely to be. How much does that matter? And what is the top thing that investors should be keeping in mind at this point?
It matters, no question about it. Early in the year, I found it laughable that there was consensus that we'd have 5 to 6 cuts in the overnight Fed funds rate by the year end. I maintained right from the start that at most we'd have 1, maybe 2, and I really didn't think that we'd have a cut until after the November election at the November FOMC meeting. But now it seems quite possible. In fact, it's highly probable that we'll get a 25, maybe 50 basis point cut in the overnight Fed funds rate at the September meeting. There's been talk, and I think it's egregiously wrong, that there would be a cut in the Fed funds rate before the FOMC meeting in September. That's not going to happen. But we're going to have cuts in the funds rate, no question about that. It'll happen after September or at the September meeting. And if I've learned one thing in 50 years of being involved in the markets, once the Fed changes its direction of policy, once they begin easing, they ease for a much longer period of time and take rates much lower than anybody had anticipated. When the Fed tightens, they take rates much higher for a longer period of time than anybody had anticipated. So when they finally do cut the overnight Fed funds rate, whether it's the September or the November meeting, that'll be the first of many cuts. We'll have 5 or 6 cuts, take the overnight Fed funds rate probably to 2 3/4 or 3% over the course of the next 2 or 3 years.
So with that in mind, Dennis, I mean, how deep could those cuts go and over that period of time, considering that some of the chief investment strategists out there are still commenting on this being an economy that could show growth without exorbitant inflation? I mean, what is the damage to the economy that the Fed would have to see in order to go down that pathway?
They'd have to see a rise in the unemployment rate above 4.5 to 5%. You're going to get that. There's no question that's going to happen. We'll probably be in recession when that occurs. I think we're already, when the data comes out, when the NBER, the National Bureau of Economic Research, makes its analysis and puts forth its report on whether we're in recession or not, they're always late. They usually tell us we're in recession when we're coming out. They usually tell us we're coming out of recession when we're going in. They are slow to make changes. I think given the fact that the leading economic indicators peaked 18 to 24 months ago, that money supply has been decreasing over the course of the past year or two, that consumer credit cards are extremely expanded, that we probably have seen the highs as far as consumer demand is concerned. I think in essence, we will see that we are in or are soon shall be in an official recession, and that'll be enough to take the unemployment rate above 5%, and that'll be enough to take the Fed funds rate to 2.5%. But that'll take a year or two. It'll be a long time in coming.
Dennis, I want to switch gears here and specifically focus on Nvidia. And I bring this up because you had made some comments recently, I think it was just about a month, maybe a month and a half ago, that the stock was egregiously overexpensive. When you take a look at the decline that we have seen in Nvidia since you did make those comments, and had been trading right around $100 a share. Now, I believe today it's right around 110, 112 here this morning. Is it attractive at this price? How should investors be thinking about the opportunity to buy Nvidia?
I think clearly from the chart you can see that we made a high in July. I think each low recently has been lower, each high has been lower. I think we're in a bear market in Nvidia, and I would not be a buyer. I'd rather own consumer disposables. I'd rather own REITs. I'd rather own dividend-paying stocks. I'll avoid Nvidia. I missed it on the way up. I'll miss it on the way down.
Dennis, why do you think we're in a bear market for Nvidia? Just given the fact that the CapEx numbers that we got from big tech over the last couple of weeks, the fact that they are so dominant within this space, why are you taking that contrarian view?
Take a look at your chart again and cast a trend line across from the going back to last year. We've broken that trend line, no question about that. The peak was in July, and again, since July, middle of July, the lows have been lower and the highs have been lower. That looks to me like a bear market. Can I be wrong? Yes, if we start to take out the recent highs made a week and a half ago, I'll be wrong. But I think if you look at that chart, that's a definitive and rather major top. So time shall tell. I thought it was egregiously overextended a month and a half ago, but then again, I thought it was egregiously overextended about a year ago. I've been wrong about Nvidia. I've been wrong about high tech, and I admit it openly and consistently.
Well, people can use all of the charting functions on the yahoofinance.com platform, Bollinger Bands, simple moving averages, what have you. Dennis Gartman, the Gartman Letter, former editor and publisher of the University of Akron's Endowment Committee's chairman. Thank you so much for taking the time.